Welcome to this week's REI Weekly Lesson. I'm Greg Helbeck. I'm the owner of Velocity House Buyers. I've been a full-time house flipper, rental, landlord guy for the last 10 years, and everything that I'm going to share with you on this video and all the other videos I put out or podcasts, depending on how you're listening to this, is from the real world. So if you get value from this video or any podcast I put out, if you could do me a favor and like it, subscribe, and then share this on social media, it would really mean a lot to me. We've been growing our channel and our podcast consistently. So today, I'm going to talk about when does it make sense to do a rental deal when the numbers are tight. So I'm just in the middle of doing a deal right now. We just got the acceptance today. And this isn't a deal breakdown. This is just a lesson, but I'm going to use this deal as a reference. This is a property where I'm buying it for about 74% of what it's worth, which generally is more than what I want to pay. I generally like to get deals at about 60 to 65 on the dollar if I'm going to rent them out. But in this case, I'm justifying my higher purchase price because number one, the seller couldn't go any lower. And number two, it still makes sense. So when you're buying rental properties, right, I would recommend you start doing that when you make enough active income in your flipping or wholesaling business to where it makes sense to buy rentals. Because if you're brand new, you're just getting started, you don't want to be doing rental properties. You want to get your active income up in the business, right? So if you have a job and you're making $150,000, you want to replace your income with your business before you start messing around with rentals. Let's say you have a job and you're making $250,000. Well, you want to replace your $250,000 a year job with $250,000 a year of real estate active income so you can essentially just wash your job out completely and not have to sacrifice your lifestyle. Once you get to a point where you're established and you're doing volume, you're doing deals, you're making money consistently, you have a somewhat predictable business, then it starts to make sense to buy rental properties. And obviously, sometimes you got to do the deal when the numbers are tight because that's the only way the deal works. So here's how I look at deals when the numbers are a little tight and it's a rental. So number one, obviously, this depends on what the value of the property is. Like in this case, the property's $195K value. I'm buying it for $145. So there's really 50 grand of like free equity I'm getting. So I'm buying equity day one. So if you're going to get built-in equity number one, it makes sense. Now, obviously, in that perfect scenario, I'd love to buy that property for like 110 if it's worth 195. So I can literally be in it for no money. But that's not going to be the case on this one. I'm going to have some skin in the game. So if there's $50,000 worth of equity and it's like 300K or less, I would go for it. If you can afford it. Obviously, if you're still looking to build up your active business, I would recommend just keep flipping and wholesaling to get your active income up, which I mentioned earlier in this video. So number one, you want to make sure there's like a $50,000 equity spread if the value is 300 or below. Now, if it's 300 or higher, you're going to want a bigger equity spread. You're probably going to want 75 to 100 if it's 3 to 600K, because obviously higher purchase price, higher taxes, higher closing costs, etc. So you obviously got to use the values accordingly. Now, number two, if the property still cash flows, right? This is a super important thing. So in this case, I looked at the rents, and the rents in this area for this exact type of property is about $19.50 a month. So in theory, you could buy it for market value and get a 1% rule because it's worth about $195. They rent pretty high because it's in a good area, Putnam County, New York. So I'm like, okay, now this property, I'm paying $145 for it, and it's going to rent for $19.50 a month. I'm getting way more than a 1% rule. So this property going to make about $260 a month after it's all said and done with the mortgage and everything. So obviously it's going to cash flow. It's going to make money every month. It's in a good location, which is my third lesson, which is location, right? Really, at the end of the day, I have 9 properties now, hopefully 10 after this one. The main thing that I'm concerned about with these rentals is the location on where they are. Because in theory, I could go into like St. Louis, Missouri and buy a bunch of $30,000, $40,000 rentals and, cash flow. But those values are really probably never going to go up. I wouldn't really say that's an opportunity that I'd be interested in. However, the rentals that I own, besides one, is in a really high growth area. It's in the Hudson Valley in New York, suburbs in New York City. People want to live there. It's super nice. So this is an area I believe, and I've seen through the data, it goes generally up significantly over time. So even though the property's worth $195 today, if I had a crystal ball, I would say in 5 years, that property's probably worth $230 to $250, and I paid, $145 for it. So obviously over time, I believe the value is going to continue to go up, mainly because in New York, it's hard to build and, there's not a lot of inventory. So that's a high growth, high appreciating area. So location matters. This is a good location. It's going to cash flow. I'm buying it at a discount. And then the last thing I'll tell you on justifying paying more for rental properties is you got to look at your tax benefits, right? So in this case, I'm an active real estate professional, which means that real estate flipping and wholesaling is my full-time thing. So I can take all of the depreciation from my rentals, all the bonus depreciation, any depreciation I get, which is a paper loss, right? I could use that, especially through a cost segregation, which is accelerating the depreciation, taking most of it year one. I can use all of those losses on paper to offset my active income. So I ran the numbers on this one. If I take 25% of my purchase price. I'll do this again. So let's say I'm paying $145 for this property and I want to take, generally it's about 25%. So I can, in theory here, take $36,250 of a loss for depreciation and use that to offset my taxable income. So I take my taxable income and then I subtract, $36,250, and now I'm paying taxes on, whatever it is minus the $36,250. I have a lower tax bill. So I'll save money on taxes. Basically, the way I ran this deal is I'm probably going to have about $36,000 of my own cash in this deal, maybe 40 on a worst case scenario. And then I'm going to be able to use that to offset my taxes. So it's basically like a wash. So that's kind of how I see it. It's almost like doing a deal for free. So it makes sense. So to summarize this video, number one, you need to be making full-time income in your flipping or wholesaling or realtor business, or else this doesn't really make any sense. You want as much money as you can to start. Number two, it's got to be in a good area. It's got to be in a good location. I wouldn't do this in a shitty location. The Hudson Valley is one of the best markets in the country. Number three, it's got a cash flow. Number four, you still want to have some built-in equity. Like if I was going to pay this lady $175 for a house worth $195, I probably wouldn't do that. Got 50 grand, which I said earlier. If it's sub 300 grand, 50K. If it's above 3, if it's in between 3 and 6, that's generally top of the rental market for most people. You want 75 to 100. So that's really, how do you justify paying a little bit more for rental property? And the last reason I made was taxes, right? Tax benefits you can take. Generally about 25% of your purchase price. By the way, I'm not a CPA, so ask your CPA about this. Hopefully you got value from this. If you did, do me a favor, subscribe, like the video. And if you are in the Hudson Valley or in Washington State, where I live, do me a favor. I'd love to do a deal with you. If you're a wholesaler, you want to JV with me, we can JV. I want to do more deals with my followers. So if you got a property in the Hudson Valley or Washington or Delaware, send me an email, greg@velocityhousebuyers.com, or a DM on social media at grego37, and I'll see you on the next REI weekly lesson. Take care.